What's going on, y'all? Welcome back to the Bitcoin Stock Show. We are going live, well now, but imminently, CleanSpark will be doing a webcast for their full year or fiscal year financials. CleanSpark reports differently than most of the other public miners, so we're about to get their full year for 2024, which is really everyone else's Q3. Make it a little bit complicated for us at the show, but hey, we don't mind it. We love a challenge here. Charlie, Will, how are we doing today, guys?
I'm good. Will, can we get a mic test?
Test.
Oh, sounds fantastic. So, Colin, let's say I don't spend all my time watching public miner earnings reports. What can I expect as a normal person tuning into this show?
Well, there's going to be a lot of dancing. And okay, it's starting. It's starting. So I'm going to unmute the stream and we'll give it a listen. As always, y'all, if you have questions, throw them in the troll box. We love our audience getting engaged. Let's keep it going.
Question
We love
and
the
answer
troll box.
session.
We'll highlight the good
If you would
comments.
like to ask a question during this time, simply press star followed by the number 1 on your telephone keypad. And if you'd like to withdraw that question, again, press star 1. Thank you. And at this time, I would like to turn the floor over to Brittany Moore, Director of Investor Relations.
Thank you, Krista, and welcome to CleanSpark's fiscal full year financial results call covering the period October 1st, 2023 through September 30th, 2024. Our press release was issued about 30 minutes ago and is available on our website at CleanSpark.com. Today's call is also being webcast, and a replay and transcript will be available on our website. On the call with me are Zach Bradford, our Chief Executive Officer, and Gary Beccarelli, our Chief Financial Officer. Keep in mind that some of the statements we make today are forward-looking and based on our best view of the world and our business as we see them today. The statements and information provided remain subject to the risk factors disclosed in our most recently filed annual report. We will also discuss certain non-GAAP financial measures concerning our performance during today's call. You can find a reconciliation of non-GAAP financial measures in our press release, which is available on our website. And with that, it is my pleasure to turn the call over to Zach.
Thank you, Brittany, and good afternoon, everyone. We appreciate your interest in our company as we share the results of a pivotal and transformative year for CleanSpark. The year marked the culmination of several years of strategic planning, preparation, and execution to fully leverage the halving event. We emerged with an optimal combination of power contracts, infrastructure, mining fleet, Bitcoin HODL, and organic growth pipeline as we enter the next phase of the cycle. Our financial performance this year reflects a sustained growth trajectory, with more than $378.9 million in revenue generated. That's a substantial increase from the $164.8 million reported last fiscal year. This year-over-year growth of over 125% demonstrates our precise execution of plan before and after the halving that occurred midway through our fiscal year. Our adjusted EBITDA of $245.8 million for the year also showed impressive growth. That's an increase of $220.8 million, or 882% growth over last year, underscoring the success of our infrastructure-first expansion strategy and its focus on fleet efficiency and operational excellence. As a result, we produced our strongest year of financial performance to date, solidifying a track record of effective execution and keeping promises to shareholders. Reflecting on the past year, our growth aligns closely with the clear strategic priorities and objectives that we've articulated since our pivot to Bitcoin mining. CleanSpark has prioritized infrastructure at its core foundation, putting us in the best position to source miners to optimize fleet efficiency and deploy new hash rate into production in the most capital efficient manner. A clear example of this strategy was the Bitmain order that we placed in January 2024. That order included 60,000 units and a strategic option to purchase another 100,000 units at the same low fixed price. This cost certainty allowed the team to focus on building and acquiring the underlying infrastructure that supported our targeted growth. Between our delivery schedule and growth in operational hash rate, the plan worked seamlessly and allowed us to reach 27.6 exahash per second at the end of September and 33.5 exahash where we stand today. This keeps us on a path to achieve our next milestone of 37 exahash per second this month. I want to discuss the way that we grew our infrastructure to support this incredible volume. There are three distinct infrastructure growth engines: greenfield development, organic expansion, and opportunistic acquisitions. Each pathway presents unique opportunities and challenges, yet our team has repeatedly proven its ability to achieve or exceed our goals across this strategy. I'd like to elaborate on these three drivers and emphasize their crucial role in advancing our strategic vision, positioning CleanSpark as the industry's leading operator. Our goal is to establish the CleanSpark way as the benchmark of excellence across every dimension: growth, scale, efficiency, capital stewardship, community engagement, and employee satisfaction, uptime, and more. We aim to set CleanSpark apart as a name synonymous with innovative and cutting-edge performance across all measures that flow through to the bottom line. Over the past 12 months, our rapid expansion has evolved our initial footprint into a robust portfolio of geographically diverse mining assets in Georgia, Wyoming, Tennessee, Mississippi, and New York. This regional structure maximizes operational efficiency, creating momentum in each local market, and disperses our mining assets in such a way as to harden us against extreme weather, price volatility in energy markets, and grid instability. Moreover, we've taken the front door approach of directly engaging with the communities in which we work and live that we templated in Georgia and tailored it to other rural communities that we call home. Allow me to highlight some other milestones we've reached over the past year. We've added over 425 megawatts to our operational power capacity, bringing our total portfolio to over 726 megawatts as of today. This expansion aligns with a threefold increase in our total hash rate, which now stands at more than 33 exahash per second, and putting us well on our way to achieve the goal of 37 exahash per second this month. This is a substantial leap from last year, when we were celebrating surpassing just 9.6 exahash per second. Our track record of execution and focus on delivering on our commitments has been instrumental in driving this performance, and we expect to repeat it in 2025 as we look to exceed 1 gigawatt of contracted capacity across our portfolio. With our infrastructure-first approach to growth, we prioritize resource allocation across our three primary growth engines. We optimize every aspect of our operations through cutting-edge technology upgrades and ensure every new facility aligns with the exacting standards of our vertically integrated business model of wholly owned, self-operated sites. Emblematic of this commitment, I'd like to remind everyone that our coin mint contract is scheduled to expire shortly, making CleanSpark's operations 100% owned and operated by the end of next quarter. Our growth trajectory has been remarkable, but what I'm most proud of is that we achieved this expansion with the highest levels of efficiency. At the core of our approach is a philosophy that extends beyond achieving the lowest joules per terahash metric for our fleet or the best kilowatt-hour price. It represents a commitment to integrity, operational excellence, and cost management that drives every decision. Growth is not solely about increasing capacity, but consistently optimizing our hardware, processes, and infrastructure to maximize output while conserving resources, ultimately delivering higher returns on investment. Our current fleet efficiency now stands at 19 joules per terahash and is significantly lower than our fleet average of 28.4 joules per terahash from September of last year. This efficiency continues to improve as we transition into the next, more methodical phase of our expansion. For us, cost reduction goes beyond mere budgeting. It is a discipline that enables us to reinvest in growth while remaining competitive in an industry where success is designed to continually get even more difficult. Operational excellence converges with these elements, ensuring that every facet of our operations, from power management to employee workflows, performs to the highest standards. This commitment allows us to pursue an ambitious growth plan without compromising on efficiency or our core values, firmly establishing CleanSpark as a leader in our field. We've achieved this level of growth through a balanced approach across our three growth avenues: greenfield development, organic expansion of existing sites, and strategic acquisitions. While our acquisition strategy may receive more attention, we remain deeply committed to greenfield development, identifying and building new sites with the talent and expertise we've developed, particularly in our newest markets. In Wyoming, we are currently contracted to add 75 megawatts in 2025 and have the potential of adding several hundred more. On the M&A front, we are realizing the rewards of our early countercyclical capital allocation. As noted, we began preparations for the halving over 24 months ago, anticipating that less efficient operators would face stark choices about their future. This foresight allowed us to position ourselves to capitalize on acquisition opportunities, consolidating over 178 megawatts in private asset acquisitions, including 9 sites acquired in September alone. Notably, after the end of the year in October, we closed the grid acquisition, which included 68 megawatts of developed infrastructure in Tennessee and over 400 megawatts of identified upside expansion opportunity. As we move forward, we are more committed than ever to our focus on Bitcoin mining and setting industry benchmarks in this rapidly evolving sector. Through deliberate prioritization, efficient infrastructure acquisition, and a reliable pipeline of state-of-the-art equipment through our purchase agreements, we've established a process that has paved a path to reach our target of achieving 37 exahash per second by year-end. With access to both power and hardware secured and a rigorously vetted growth strategy, we have a strong track record of execution that aligns seamlessly with our vision for 2025 and beyond. This strategy, grounded in countercyclical investment and the use of multiple avenues for efficient growth depending on current market conditions, has laid the foundation for our next milestone, of 50 exahash per second in 2025, while insulating our growth plans from the cyclical nature of the industry. Having overcome the challenges of finding the right approach and developing a winning formula, we stand ready to sustain our growth, even as we've entered a bull market, which will have the potential to inflate industry asset prices and may lead our competitors to make decisions that could ultimately prove to be capital destructive. As a result, we may turn our focus away from additional consolidation and towards maximizing the organic growth potential within our existing portfolio, providing us with great confidence and visibility on our journey to 50 exahash per second and beyond. Our decision-making process will be guided by delivering ROI to shareholders as we evaluate the options available. Before I finish, I'll comment on the recent trends that dominate conversations about our sector. While some competitors have diversified into AI and high-performance computing, we remain committed to Bitcoin mining as a vertically integrated, pure-play operation. As we stay focused on mining Bitcoin, we start generating revenue at greenfield sites in as little as 6 months. By contrast, a move into the AI or HPC space could extend that timeline significantly, potentially up to 3 to 4 years before our investors would see comparable high-margin revenue. This shorter payback period to revenue in Bitcoin mining underlines the value in our commitment as we deliver returns to our shareholders above all else. We will evaluate new opportunities on a case-by-case basis, but we believe in remaining focused on our core strength, at least for now. This conviction stems from the fact of Bitcoin's finite supply, which we see as a long-term support for our disciplined approach. In our view, each dollar invested in non-core areas represents a potential distraction at this phase in our growth. As we rinse and repeat our playbook into the future, we strengthen our path towards a dominant position in the mining space. In summary, we are extremely pleased with the results achieved this quarter and fiscal year. As we look ahead, we are confident in our path to growth. We are on a track to surpass 50 exahash in 2025, with plans to continue growing and expanding our operations. Our vision goes beyond reaching this milestone. It encompasses building a business that is scalable, resilient, and repeatable. Our growth strategy is rooted in operational efficiency, driving strong margins and consistent performance. We've successfully delivered similar results before, and we are committed to achieving sustainable growth again. In 2025, we will focus on increasing our installed hash rate and boosting our monthly Bitcoin production, and always look for any opportunities to drive revenue and margin expansion. As we look ahead, timing is everything, and we position ourselves to fully capitalize on the current bull market. We're uniquely positioned with our power assets, and mining Bitcoin represents the best way to monetize them, especially in favorable market conditions like we see today. During this time, we'll continue to optimize cash flow and explore diverse sources of new capital to deliver value for our shareholders, but never at the expense of our core operations. Finally, I'd like to extend my heartfelt appreciation to the team at CleanSpark. Their relentless effort, creativity, and commitment are the engines behind all we achieve. Each success we celebrate is a direct result of their dedication, and it's a privilege to work alongside such inspiring professionals. With that, I'd now like to turn the time over to Gary to review the quarter and fiscal full year financial results in greater detail.
Thank you, Zach, and good afternoon, everyone. It's my pleasure to review the detailed results for the full 2024 fiscal year. Hopefully, you've had a chance to see the earnings release, which has been posted to our website. We anticipate our Form 10-K will be posted before market open tomorrow. As Zach said, it's been a pivotal and transformative year, and our financial results reflect this. The central fact of fiscal year 2024 is that Q4 was the first full quarter following the most recent halving event. Warren Buffett has famously said, "When the tide goes out, you find out who has been swimming naked." While I differ with him when it comes to the prospect for Bitcoin, Mr. Buffett's quip is a perfect metaphor for the impact of the halving event on the weakest operators in our space. When the tide came in this time, CleanSpark had nothing to be embarrassed about, and in fact, we're downright proud of our performance, one that fully justifies the pivot to Bitcoin mining we made several years ago. Our revenues for the year were $378.9 million, an increase of approximately $210.6 million, or 125%. This increase was primarily driven by the increase in our Bitcoin production, as well as a steady rise in its price. For reference, we produced approximately 7,100 Bitcoin for the fiscal year, compared to approximately 6,900 Bitcoin for fiscal year 2023, which shows we have managed to outpace the significant increase in difficulty in the pre-programmed halving event in April. Our gross profit for the year was $213.5 million, an increase in approximately $138.6 million, or 185% over the prior year. Again, the largest contributor here was the average Bitcoin price, which was significantly higher than last fiscal year. We also saw lower energy prices on a per kilowatt hour basis in fiscal 24. Looking at our GAAP net loss, we saw a loss of approximately $145.8 million for the fiscal year 2024. I want to point out that a large part of our net loss is due to a non-cash impairment expense of $197 million, most of which was recorded as of our last quarterly report. Finally, with respect to adjusted EBITDA, this non-GAAP financial metric increased to $245.8 million, compared to approximately $25 million in 2023. The largest contributor to this increase was due to the increase in value of Bitcoin, as the company adopted a new accounting standard, allowing it to mark to market its Bitcoin balance at each balance sheet date. I want to take a moment to discuss our power costs for the entire year. All-in power costs at our wholly owned sites for fiscal year 24 were 4.6 cents per kilowatt hour, which is lower than our all-in power costs in fiscal 2023 of 4.8 cents per kilowatt hour. Our wholesale electricity costs in 2024 averaged 3.1 cents per kilowatt hour, with prices as low as 1.2 cents at points during the year. Included in our all-in power costs is an additional 1.5 cents per kilowatt hour of costs related to transmission and distribution, profit margins to the cities we operate in, and taxes. Management considers its all-in power costs, which include these fees and costs on top of the wholesale electricity numbers when analyzing its operations. we believe that we have one of the lowest all-in power costs amongst miners in the industry. And when combined with our uptime, CleanSpark is one of the top performers. I also want to point out our cost to mine a Bitcoin. Our average cost for 2024 was approximately $21,400 for our wholly owned facilities. Looking at the fourth quarter specifically, our cost to mine a Bitcoin was approximately $36,250, which is an increase of 35% over the third quarter's cost to mine of approximately $26,950. As a reminder, rewards were cut in half 20 days into the third quarter. As Zach mentioned earlier, October marked the closing of our deal to acquire Grid Infrastructure, a Bitcoin miner with operations primarily in Tennessee. Grid boasts 53 megawatts of installed capacity, and we've already begun greenfield development of another 80 megawatts, fully building out a location in eastern Tennessee, while also breaking ground in Jackson in the central part of the state. Grid's footprint in the rural southeast is one that we're familiar with, and we're already porting best practices in community relations that we developed in Georgia to the cities and towns in Tennessee that we now call home. Better still, Grid developed a deep partnership with the Tennessee Valley Authority, one of the nation's premier providers of reliable and affordable power. Thanks in large part to Grid's efforts, TVA's senior management understands the benefits Bitcoin miners bring to the TVA system, while also providing desperately needed revenue to local power providers who have excess capacity but little hope of attracting large industrial customers to their communities. One of the challenges of the quarter came in September when Hurricane Helene made landfall in the southeastern U.S. and disrupted operations at our facilities in Georgia. We suffered a partial outage for 2 to 3 days that reduced revenues by approximately $1 million per day. However, we suffered no property losses and made no insurance claims, a testament to the build quality of our facilities and the effort of our team to harden the sites against damage ahead of one of the worst storms to strike the U.S. in recent memory. But controlling insurance costs means more than limiting claims. It also means working with our insurance company to craft the best coverage at the best price. We've also made significant progress containing costs for property and casualty insurance. Insurance expense for the year was approximately $5 million and is one of our larger G&A expenses. While we expect insurance expense to grow due to the large dollar value of our assets in operation, in November, we renewed our policy and cut our comparable rate by 25% going forward, owed in large part to the growing scale, quality, and diverse geography of our operations. On final note, I want to talk about our balance sheet and our liquidity position. As I previously mentioned, we've increased our Bitcoin holdings almost 260% in the year, and that number as of today is rapidly approaching 10,000 Bitcoin, which would represent almost $1 billion at current Bitcoin prices. We also had approximately $121 million in cash as of September 30th, which represents a significant liquidity position going forward. From my perspective, we have set the stage for a successful fiscal 2025 after navigating the halving in better shape than the rest of the industry. Not only do we have significant liquidity, but we have one of the industry's most efficient fleets at an average of 19 joules a terahash. We have a low cost to mine Bitcoin and industry-leading uptime. Bitcoin mining is a capital-intensive business that requires prudent growth and sufficient scale to succeed over the long term. Our company-wide commitment to this principle allows us to drive value through countercyclical investment, opportunistic growth, and increased operating leverage through continued scale. In August, we used a portion of our Bitcoin holdings to secure a $50 million line of credit with Coinbase, something that helped us take advantage of opportunities in the marketplace at a low cost of capital, which currently sits at an annual rate of 8.5%. Looking forward to fiscal 2025, we'll look to find ways to monetize or leverage Bitcoin on our balance sheet as we establish a digital asset management group within the company. Working with staff who have joined CleanSpark as part of the acquisition of Grid Infrastructure, we'll look to more actively manage the Bitcoin on our balance sheet with an eye toward capital preservation, generating yield on our Bitcoin, and protecting against price volatility. Heading into this new year, we have significant scale and size, a healthy balance sheet, industry-leading operations, and a strong liquidity position. We are well positioned to pursue diverse capital raising strategies. With that, I'll turn the call back over to Brittany to open the floor for questions.
Thank you, Gary, for that detailed financial overview. We will now open the floor to questions from the analyst community. Operator, please provide instructions and manage the queue for the Q&A session.
Thank you. Ladies and gentlemen, at this point, we will begin the question and answer session. To ask a question, you may press star and then 1. And if you would like to withdraw your question, again, press star and 1. If you are using a speakerphone, we do ask to please pick up your handset prior to pressing the numbers to ensure the best sound quality. Your first question comes from Mike Colonnese with H.C. Wainwright. Please go ahead.
Hi, good afternoon, guys, and congrats on a very strong fiscal year here. Just a couple for me. First, it would be great to get your perspective as to why you believe the miners have lagged Bitcoin this year, especially considering that, at least historically speaking, CleanSpark and some of the other top-tier miners in the space have actually outperformed Bitcoin during this stage of the cycle. It'd be great to get your views there.
Hey, Mike, thanks for joining the call. I think the key with this is you have to zoom out a little bit. If you zoom out a little bit over this, call it a 2-year period, the miners, CleanSpark included, have meaningfully, continued to outperform Bitcoin. I look at this as, Bitcoin's catching its breath and catching up. But I think it's positioned us incredibly well for what is optimally going to be a slingshot in value as the market begins to better understand what the miners can do and how the yields continue to be generated. So hopefully I see this as just a plateau point right before we see another upswing.
That's great. Great to get your perspective, Zach. And I'm curious if you could provide some more insight in terms of how you're thinking about the current market environment for ASICs. I know you're looking at 50 exahash by the end of next year, but how should we expect CleanSpark to approach the ASIC market? How are you thinking about pricing and future repurchases here?
Yeah, the key for us is we've already locked in price certainty. I mentioned during the call the S21 Pro purchase, which was 160,000 miners, but we also have the XP purchase, which is a meaningful option for us. So in addition to the miners we've committed to that essentially get us just about to 50, we have the ability to take down even more. So there's another 50,000 units with price certainty on them. So we don't have to worry as much about that swing in whatever the market does. Again, certainty is what we created. We actually have price certainty through 63 exahash on the ASIC market. With that said, regardless of where the ASICs are at on the go forward and in the future, beyond that, we've proven that we have a great track record of having a best-in-class purchasing. So wherever the market lands, we will make the right capital decision on timing of investment, when to add more to those options, when to take down the option, and how we deploy that. So again, I think we've handled it really well as a track record based. We have enough optionality ahead of us over the next, I'll call it 6 months. But definitely, our relationships are strong. So I expect regardless, we'll get best-in-class pricing.
Thank you for taking my questions.
Your next question comes from the line of Brian Dobson with Clear Street. Please go ahead.
Good evening. I want to talk about this digital asset management initiative that you highlighted. I suppose what are some of the paths you can take to generate yield on your HODL, and what level of yield do you think might be possible?
Yeah. Hey, thanks for the question, Brian. Look, we're quite excited about pursuing this digital asset management strategy as well. But I'll say that we're going to pursue a strategy of crawl, walk, run. And really, that's going to be, rooted in a first focus in making sure that, we preserve the capital, right? Because when you have the Bitcoin HODL balance that we have, we want to make sure that we really protect that. When it comes to finding those opportunities to generate the yield, we're looking at various strategies right now. We just closed the grid transaction here end of October, so the team's just getting up to speed and really looking at who those partners are. But ultimately, it could take, various forms of providing covered calls, lending to Bitcoin. There's even some talk about, providing liquidity to ETFs in the marketplace. So, but you'll expect to hear more information from us as fiscal year 25 goes on. and we'll really be focused on getting a healthy return on those assets as the year goes on.
Great to hear. That's very exciting stuff. And then I guess just stepping back, maybe we can look at the big picture for the industry. What trends do you expect to drive mining in 2025, and how has the recent presidential election impacted your outlook for doing business in the United States?
Yeah, so from a trend point of view, I think that, we have a lot of tailwinds right now. And that has, to hit your second point on the political side, I think we're going to see a lot of opportunities in the capital market further opened as we see a change really on the SEC side. It's been a tough couple years for anybody involved in this sector based on how the regime was previously run. So I think capital is going to open up even more than it already has in ways that will be very positive. In addition to that, I think we're going to end up with regulatory certainty, but just generally a friendlier regulatory environment. So we're incredibly excited about how things go. Now, from an industry trend point of view, I'm going to go back to something that I've kind of been beating the drum on, and that is scale matters. And so the bigger miners like ourselves are going to continue to get the best access and the best pricing to capital, which is going to create the best access and pricing for opportunities. I do think that acquisitions are going to look differently. Private miners are still in the same situation. Just because capital opened up to the publics doesn't mean it's necessarily going to open up to the private miners. So there's still going to be opportunities there. But how we view them is going to really come down to valuation. Where we've seen, people that are very reasonable, they come in at the same valuations. We've also seen, private miners that want substantially higher valuations. This comes down to my comment where I said, we're going to avoid making the wrong decision, but we do think miners that have fallen behind may be put in a position where they may choose capital destructive activities as we view them. So there may be some headlines on opportunities that we pass on. And we pass on because it doesn't create the ROI that we want to have. Just because Bitcoin's up, we still have to measure timing to ROI for any investments we make, and that's incredibly important to us. So again, a ton of opportunity in the future, but we're going to approach it with a very measured approach. The great thing is we have several hundred megawatts of opportunities for organic growth, and we've proven that we have a track record of being able to build sites. And so we're going to focus probably in 25 more on building than on buying.
Yeah, excellent. Thanks for that color. And I suppose just as a final question, have your thoughts on HPC opportunities changed at all since your last call?
No, we still think that a very focused approach and what we have, as Gary mentioned, we had a great cost of production of Bitcoin, and with Bitcoin going up, that even further enhances what was very healthy margins. And so when you look at margins that we can produce essentially tomorrow, right, on any opportunity we look at, the path to high margin revenue is quickest for Bitcoin mining as compared to HPC, and it's not even close. So until such a time as that changes, we are going to stay very focused on what we're doing and what we do best, which is Bitcoin mining.
Excellent. Great to hear. Thanks very much.
Your next question comes from the line of Tyler DiMatteo with BTIG. Please go ahead.
Hi, guys, and thanks for taking the question. Zach, I wanted to follow up on your comments there in terms of the buy versus build decision and how you're kind of prioritizing maybe the build decision in 2025. I guess, where do you kind of see the opportunity in terms of the current footprint? I know you have Wyoming, which is, some incremental couple hundred megawatts. I guess just how do you kind of think about the footprint here more broadly and what's the most readily available as you look out to next year, broadly speaking?
Yeah, I'm going to speak broadly about, we see the U.S. still as a very ripe opportunity. And it's because we understand power markets here, but we think that based on the changes in the administration, that the power markets will just continue to get better. The U.S. is full of abundant low-cost power if you know where to find it. And we focus heavily on rural areas that are being overlooked as an opportunity. So that's where we see the opportunity being the best in the U.S. is in rural USA. And as we go to these towns, we find that, I look at it this way. If we're going to build something, the best opportunity is to build hardened, immersion-cooled infrastructure. And if we're going to go buy something, there's a lot of air-cooled infrastructure readily available. So that's really going to be how we look at this, is first, rural America. Second, the majority of our builds are going to be immersion-based. And if to the extent we do M&A, which I'm sure there'll still be some, it'll probably be air-cooled. But it's going to be in areas where the advantages to air-cooled are going to be that we can turn it on immediately. It's that turnkey, walk in, generate revenue. And again, we've built our immersion and air-cooled systems in a way that we can now build for essentially the same cost. And so that's how we're viewing how we're going to build and how we're going to buy and where we're going to do it.
Got it. Okay, thankful. And then my follow-up here, just wanted to talk a little bit about fleet efficiently. You guys have done a nice job over the last year improving that. I guess, how do you kind of think about that going through the next 12 months here? And more broadly, as an industry, in terms of newer generation of rigs, how do you kind of think about the step function of fleet efficiency and kind of where, that improvement can really end up over time, as we're, kind of sitting in this high teen joules per terahash, but potentially other rigs coming down into the, low double digits?
We're adding latest generation. So, we're adding the latest generation rigs that are in the 13s already. But what we're not doing is we're not retiring things without need. So yeah, we still have some XPs online because they are generating meaningful capital, and it's not capital that we're going to throw out baby with the bathwater just to chase a number. That's one of the key things that we want to drive home is that it takes balance when you're talking about capital allocation. So we're not going to chase the lowest number at the cost of spending capital for, ways that's essentially unnecessary. And so we do expect to move from, 19 to 18 to 17 and so forth, all the way down. It's going to be an incremental path that's going to be very measured about return to capital to our shareholders. Now, where do I think that, we're going to go from a Moore's Law point of view? I think we're going to continue to approach, that 10 or 9 level. And then I do think that's where technology changes are going to be required. The chips are going to be able to do it, but what about the heat extraction? This is part of the reason we're going to build more immersion into the future. I think that air-cooled heat extraction will get more difficult over the next 4 years. And so it will be more valuable to invest in immersion. Do I think that we'll get into the single digits and continue to go? Moore's Law says absolutely we're going to do that. But it's about having the infrastructure ready and available to accept the newest technologies as we progress. Because this is not a measurement of where we're at today or where we're at tomorrow. This is a measurement about how are we going to use capital efficiently to have the right mix of efficiency and power price, generate yield, not now, but also at the 2028 halving. So we're going to look at this really over the entire cycle. But we do think that immersion is going to be a key role in kind of keeping up with that efficiency.
Thanks for the color there, Zach. I'll turn it back to the queue.
Your next question comes from the line of Brett Knoblauch with Cantor Fitzgerald. Please go ahead.
Hi, guys. Congrats on the quarter, and thanks for taking my question. Maybe just touching on CapEx for a minute. I know you guys have kind of pre-fixed prices on the miner side, but on the infrastructure side, the build out in Wyoming and likely other locations, I guess, what should we be expecting for next year? And in terms of liquidity, would you tap into the Bitcoin position, or would you rely just more on the equity markets for funding the remaining build out and mining purchases?
So, we think that the markets are going to be a lot more open to, diverse options. So I'm not going to commit to any one type of capital at this point in time. We think that there's plenty of room to expand our ability to leverage our Bitcoin further, but there's also other, there's the equity markets, there's non-dilutive, access to capital we can do. There's just opportunity. That's the great thing about being a Bitcoin miner right now is capital markets are open for business. And so how we do that is going to be whatever is going to generate the best return to our shareholders. From an infrastructure side, kind of to your point, between here and 63 is about roughly a $200 million investment. And then, the miners on top of it, which we've secured at, very advantageous prices. So there's not a huge barrier between here and getting to, beyond 50.
Perfect. Thank you. And then maybe just on the M&A landscape, I guess post-halving, I thought it'd be, there'll be a lot more deals than we saw, and I know you guys have been aggressive. Do you think the reason for maybe not seeing more deals in the space is that a lot of maybe the sub-scale miners were looking into alternative use cases for their facilities like AI, HPC, and maybe they're evaluating that before they kind of consider selling, or we see another wave of consolidation?
I think it just depends on where you were at. We've obviously took advantage of a lot of private opportunities that existed. I think that there's still a lot of people that believe in Bitcoin want to continue to mine privately. And so I think that that's where we're going to see some additional opportunities come, is the private miners that wanted to see the other side of the halving. You remember, Bitcoin has proven itself to be very cyclical. And, there was generally in past cycles, it took 180 days plus for Bitcoin price to really adjust. We saw that happen this time around. So there's also the reality where some private miners, they basically just held off. They didn't run anything, and they waited for the 180 days to go by to turn back on. I think that we're going to see some of them, I'll call it, exhaust themselves as whatever fleet they had that they just kind of held on and waited to turn back on until Bitcoin broke, for example, 75,000. They're going to have a real decision to make whether they upgrade their fleets or whether they put the facility up for sale. And I think we're going to see quite a few facilities come up for sale after they get one more bite of the apple from a ROI on machines that they maybe bought 4 years ago. And so I think that there's a second wave of private acquisitions to go on. And I think on the public side, it's complicated to do any sort of public deal, and it rarely makes sense to pay the premiums that a public-to-public transaction would require. And so you really have to find the diamond in the rough that makes sense. And that's why I think there wasn't more public-to-public consolidation also.
I guess as you look at the public miners, I think, the top 10 largest have kind of owned, call it 25% of network hash for the last 18 months. Do you think that changes over the next 4 years? I guess talking about yourself and just, the industry as a whole, or do you think other, nation state backed entities are going to increase hash maybe faster than public entities are? Or how should we think about just kind of like your share of rewards going forward?
I think that we will see some nation state mining, of course, but I don't think it'll overtake kind of a public market side of mining. And the reason is we just have different reasons to mine. A nation state's going to want to mine just as to kind of pad the balance sheet on one side, or to just add to their own treasuries on another. Whereas, as a public company, we're incentivized to really maximize and build on our percentage of market share or global hash rate. And so I think that's going to continue to drive miners to either, increase or at least stay where we're at as a percentage of global hash. So I think that, if you think about it a different way, is, we may be competing a little bit, but we're incentivized to keep up.
Perfect. Thank you, guys. Really appreciate it.
Your next question comes from the line of Reggie Smith with JP Morgan. Please go ahead.
Hey, guys. Thanks for taking the question. I wanted to follow up. I know you talked about locking down or guaranteeing your price on devices. I was curious what, if any, impact tariffs could have on that. I'm not sure the relevancy to the space. And then I have a follow-up. Thank you.
Yeah, it definitely could. Now, the units we're buying are not coming directly out of China. They're coming out of other, Asian markets. But what we've also seen, and I think it's been an anticipation of this happening, is we've seen most of the major manufacturers build out their production capabilities to include Mexico, which again is still another place that may or may not have tariffs on the next upcoming future, but also domestic. I think that as we see some of the foundries that are starting to get built under the CHIPS Act actually come into reality over the next couple of years, we're going to see a lot of them having domestic capabilities. So I think that there's at least some tariff risk on that no one can protect against, because it just depends on, when you bring it in and where you bring it in from. But that's also the benefit of having a very large fleet stateside. One way to look at it is, if we're at 50 and somebody else is at 20 and they want to catch up, they now have to pay the tariffs on everything in the gap to catch up. So I think there's going to be a potential barrier to growth for some of the smaller scale miners. And of course, smaller you are, the more expensive your capital is. So again, I think scale matters in a lot of different ways when you look at that. But we'll see what happens with the tariffs, and we'll react accordingly.
Got it. Now that makes a lot of sense. I hadn't thought about it as a barrier to entry for smaller guys to renew or refresh their fleet. So that's a good point. So another question. We've talked about this kind of build versus buy, and obviously the discussion thus far has been mostly around like building your own sites versus acquiring a site. Curious your thinking on just buying Bitcoin outright, and what could happen that may change your view on that. I bring that up because obviously there are two big players in the space that have been pretty aggressively buying Bitcoin. I was curious where you shook out on that. Thank you.
So how we look at this issue is it's the right time, right place. It's a never say never as part of our strategy to continue to manage our HODL balance. There's going to be times where we're going to buy and sell Bitcoin in certain transactions. In addition to just kind of buying to add to the HODL, one of the things we pay close attention to is basically the average value of what makes up our cost basis for our HODL, which we believe to be amongst the lowest because, of course, we're producing it at very healthy margins. So really what the way we look at it is you're faced with the decision: do you buy assets to produce Bitcoin on a reoccurring basis at what right now is better than 50% margins to spot price, or do you go buy Bitcoin? And again, it takes a more long-term view on that when you're buying assets to produce Bitcoin than just buying Bitcoin tomorrow. But again, I think that for the right strategic reasons, we're absolutely not opposed to it. We just feel that the best use and the highest return of capital to our shareholders has really been either buying or building facilities that produce Bitcoin. Now, we are amongst one of the top 10 corporate holders of Bitcoin, and we do monitor that and plan to, of course, increase our standing on that list. And some of the miners that are buying are also the same ones that are mining at a loss or a very small margin, so they have less advantages than we have.
No, I certainly appreciate that. Thanks for the insight and the color as always, guys. Great quarter. Congrats.
Thank you. Appreciate it.
And that concludes our question and answer session. And I will now turn the conference over to Brittany Moore.
Thank you for joining us today. We appreciate your interest in CleanSpark, and we look forward to speaking with you again next quarter.
Ladies and gentlemen, this does conclude today's conference call. Thank you for your participation, and you may now disconnect.
Yeah, we're not disconnecting. We're still here, though. We are still here. We got Penny and Nick joining us.
A stacked panel today, fellas.
Welcome, guys.
Penny,
I
Nick,
think
how
Nick's
y'all
going to
doing?
unmute himself. There we go. What'd you guys think? Colin, I'll give it to you first. I feel like you're the ringleader for these shows anyway, so
yeah,
really
I think I'm gonna kick it over to Penny and Nick for first thoughts. Penny, go ahead and give us your initial reaction, then Nick, you can hop in.
Well, my initial reaction, I posted on Twitter, and it's basically, looking at Q4. I just want to know what their mining operations are looking like most recently, not for the full year. So to get the numbers, you have to look at the last report, which has the last 9 months, and then you get the full year numbers and you subtract them all. So you just look at Q4. And the thing that popped out to me was just their OpEx costs went up a lot. That would be, I have them listed there. Sorry, I don't have the sheet in front of me. Yeah, the payroll expenses, professional fees, payroll expenses, general and administrative, they all went up significantly, and it sort of increased their hash cost relative to Q3. And I would expect their hash cost to have gone down. I was thinking they'd be in the 40s, but it looks like they're growing their overhead costs. And they spoke to it a little about insurance and stuff, but it's really, at some point you have to grow into your overhead costs, not just continually grow them. So, I was a little disappointed. That's my main takeaway, and didn't hear any of that asked by the analysts. Would have liked to had some color on that.
I know it's early. Did you get a chance to dig into what costs increased the most as a percentage?
For each of those three things?
Yeah.
No, not as a percentage. Let's see. Well, it's hard because some of the things they write off, they write off a couple things like fees related to financing and biz dev, and I don't know if I assume maybe that goes in professional fees, maybe it goes in payroll expenses, maybe it goes in general and administrative, and then there's another one for litigation and settlement expense. So it's hard to know which thing to take out the exclusions that they put in. So I just add them all together, and I see it went up from 23.2 to 32.
Got it. I guess their stock. So it would stock-based compensation affect that number, given that their stock is effectively up, let's call it 100% more or less from October 1st.
They could bake.
Definitely no. I only count the cash cost, so I take out anything they exclude in adjusted EBITDA, which is like stock-based comp and the other things I was talking about, like the one-off fees, legal fees, and biz dev things.
How did you see stock-based comp though? Did they break that out in their press release? Because we don't actually have their.
It is. It's in the adjusted EBITDA. You see all the those are basically all the non-cash costs and the one-off cash costs they think are not part of like ongoing business. So I think the total for the whole year of stock-based comp was 29.555. But anyway, yeah, the story there for me is, their OPEX or SG&A, whatever you want to call it, that's going up faster than their hash rate is. So, they didn't improve on a hash cost basis. And if you just look at what their cash expenses were for mining, they got, 89 in revenue, but their cost of revenue was 57 and their cash SG&A was 32. They basically perfectly broke even. So they didn't really make any money mining for all of Q3. Which to me was surprising. I thought they'd make a little, but that's because I thought their hash cost would have gone down a little, but it basically stayed flat.
I wonder how much of the acquisitions factor into a lot of these overhead costs that we're seeing. And I'm curious to see what they actually list in their 10K when they finally file it. They haven't done it yet. It looks like they filed for an extension for it, so I don't even know if we'll get that this week.
He said they expect it tomorrow.
Is that what he said? Okay.
Yeah, in the call, yeah.
I was distracted trying to pull some more numbers, so thanks for that, Penny. But yeah, I'm curious to see how much of that factors into this. You mentioned, Penny, and you wish that some of the analysts had talked about this, the insurance costs that are related to some of these sites. And you made a good point in our private chat that this is actually a consideration for maybe trying to keep all of your eggs in one basket as a miner, where if you can just insure one site, it's going to be a lot less overhead, potentially less expensive, and just easier for you as an organization than if you're insuring like a dozen sites at this point, more than that with CleanSpark. Because they've got sites in how many different states? I can go to their overview.
5, I believe. Mississippi, Georgia, Tennessee, Wyoming. It's 4. Yeah. And the coinment thing is expiring. So is that the New York one?
Yeah, that's New York. That's their only non-owned facility that they are hosting there. And I think, they're going to let that expire. But Nick, we didn't give you a chance to give your thoughts on this. If you have them, I don't know if you have anything that stands out to you.
The tariff question is certainly interesting. I mean, that's not just a question for CleanSpark; it's probably for all of them. So getting all the pubcos to opine on that is definitely going to be it's going to be interesting what they're hearing. Obviously, CleanSpark was one of the companies that was represented at the roundtable, so maybe they have, they may have the ear of the new administration. So interested to hear what comes of that. That's something to definitely keep an eye on. It seems like, honestly, it seems like a pretty decent quarter for them. I know looks like they're trading down a little bit after hours, maybe 4 or 5%. But yeah, I guess, it is a concern across all pubcos that, expenses increasing faster than hash rate and also efficiency. So we'll see. I guess we'll have to see kind of I'd be very interested to see how Q4 goes, given the meteoric rise of Bitcoin price, where there are those costs increase. As the CEO of a private company, we have employees in lots of different states. Our costs increase for every state that we add, and we don't even have any physical locations really. We have like a warehouse in Montana and some other things like that, but nothing like massive sites like these guys have. I have to think that increasing the number of locations you have increases the operational complexity of the business. So that may be something to kind of keep an eye on as well. So as they, find more and more sites in more and more states, the cost of operating gets increases as well.
Yeah, I'd be really, like I said, I'm curious to see what we can dig out of their SEC filing for breaking out some of these costs specifically, because that's been, their MO is basically just finding turnkey sites and gobbling them up. That's kind of what put them on the map. A few years ago when they went from basically being a no-name public miner to one of the largest ones in the game. And just looking at some of the M&A activity so far this year, Will and I covered this last week on the Bitcoin Stock Show, but obviously the Grid deal, which was completed on October 30th. The enterprise value for that was 155 million, based on Grid's liabilities from their Q2, because the deal was structured as such where basically they would pay out Grid the enterprise value less their liabilities. The deal was 80.37 million, and Grid's megawatt capacity at the end of Q2 was 68 megawatts. So that was, I think Zach mentioned it on the call. Obviously, a good thing for Grid, but also potentially good for CleanSpark, just for the fact that they get to further entrench themselves in the TVA region. A lot of cheap power in East Tennessee and in the Tennessee Valley area because of an abundance of hydro and an abundance of nuclear. A few other acquisitions from this year: the Exponential Digital acquisition, which was 27.5 million in cash, and they purchased 7 Bitcoin mining sites in Tennessee for a total of 85 megawatts. I mean, that just kind of to hammer home that point, a lot of CleanSpark's capacity is spread out across a lot of small sites. And I wonder how, Charlie and Nick, y'all have both operated mines before. Going back to Penny's concerns about operational costs, this has to increase complexity and cost to some extent, right? Because you don't get like maybe the same economies of scale within like one single site.
Is it like that crazy though? Like like one employee per how many megawatts nowadays? Nick probably knows off the top of his head.
We usually say somewhere around 10. So 1 employee per 10 megawatts. But that number does seem like it tails off above a certain amount.
Yeah.
But yeah, it seems like around 1 employee per 10 megawatts. But you need 1 employee per site. So if you have a bunch of 8 megawatt sites, you kind of need 1 person there per site, regardless of whether they kind of reach the 10 megawatt threshold.
Well,
and of course, that drastically can be different per site as well. Like there are probably some sites that need more or some sites that need less. It really depends on a site per site basis. Something I mentioned like before is like energy is sparse. It's dispersed relatively equally across the globe. And so you'll find like pockets of density, but eventually you'll have to become more geographically diverse. All right, over to you, Charlie.
Yeah, I was going to echo pretty much what Nick said. I think one additional color is that from an operations perspective, you can almost differentiate. You have like a tech person who can do 90% of the work, but it's equally important to have like a shot caller decision maker who can be present. And I think that type of person and that type of like operator is pretty sparse in Bitcoin mining. And if you have a bunch of these sites clustered, a couple hours away from each other, that can make a lot of sense because you can have like a regional manager type deal. But if they're really disparate and really far, like, it's really hard to like find the right person and convince them to go live in the middle of Wyoming and run your site up there. And like, I think that's an underappreciated limiting factor. So that could be like a huge
Sounds like a
SPA.
personal complaint.
So you're making an argument for them to buy more jets? But it's to this overhead thing. Speaking to this overhead thing, I mean, I've never run a mine, but I imagine at their scale, there's certain things like every site's going to need security. You might have to do some work at the site, put fence, like whatever you have to do. There's like always an other category. There's rent for whatever, or the lease. There's water. There's taxes. There's insurance on it. And then you're probably, like you said, you probably need a manager or some guys that know what they're doing just as overhead there. And then and also at CleanSpark scale, aren't they doing their own ASIC repairs? So every site needs all those materials and those people. And so it's, it doesn't, each site probably scales well as it grows, but, it might be more cost effective to have like a mega site, like a gigawatt site where everything's all there. So regardless, I mean, it's showing up in the numbers where their costs are growing faster than their hash rate. And it's surprising to me no one asked about it, and they didn't really give guidance on it either. Like if I were an investor, that my number one concern would be, well, are they going to produce Bitcoin at a low cost? Now it's 44 hash price. Maybe I can live with that because maybe I think hash price is going to 70 or 80 or 100. So okay, maybe, but how's it going to play out in the future? And like, is there going to be a realized economy of scale or not? So that's what I find a little confusing.
Well, you're not saying.
Go ahead, Nick.
You're not saying that you think hash price is going to 70 or 80. You're saying that if you did think that, you should make an investment based on, you should consider your investment accordingly.
No, I'm saying if, I see that their hash cost is 44, and if I think hash price is going to 70 or 80, what's another $4 off on hash cost, right? Like I'm going to make the money from hash price going up in my mind. That's how these pure play miners are priced. So, what's a little bit shaving your costs a little bit, what's that really do for you? It helps a little, but if the thesis is Bitcoin's going way higher, it doesn't make a huge difference. But if I'm thinking about the company long-term, like I'd want to know that at some point they are driving down their hash costs, and what am I going to be paying in the future for operational costs and things like that? Like I want to know how they're like taking on those issues.
Yeah, but I think you kind of hit the nail on the head there, though, Penny. It's like we're in a bull market, so most analysts don't care about that. They just want to see growth, and they're kind of like waving their hands about what the costs are going to be and just kicking that can down the road. And they aren't
not only waving their hands, but just like deferring to what management says. Oh, you mine coin at 30,000 each, okay? Yeah, that's just your electricity cost.
The other thing that I think you pointed out rightly in our private chat here is a lot of those are sell side analysts, right? So they're not going to necessarily bite the hand that feeds, so to speak, or try to make the stock that they're covering look unfavorable to others.
Penny, I'm curious.
Go ahead.
Go ahead.
No, you go ahead.
So Penny, that we've had Iris Energy, Marathon, did Riot's Q3 come, right? Yep. So I guess this is for Colin and Penny. How do you guys compare like some of the majors that have come out in the last few weeks? We're going to do this in the newsletter that'll come out Wednesday. So we'll have a more full breadth take. And if you are listening to this on the podcast or just live stream, just go to blockspace.media and you can find our newsletter. But how do you guys compare this to the majors that have come out recently? Is there like disappointment, or is this like pretty in line with the other ones, or is this even better than some of the other ones? How do you guys kind of rank them? I'll throw it to Penny first.
Who's going first?
No, you go ahead,
to you.
Penny.
Okay. I expected CleanSpark to do a little better with these costs. Again, like I care about the hash costs. I want to see who's doing the best there, who's making the improvements or whatever. CleanSpark's always been one of the front runners there. They just like solidly operate, and so I was expecting them to drive it down as they sort of upgrade their fleet, but it basically stayed flat. It went up a little. So they're like kind of nowadays they're kind of middle of the pack. There's probably, say, you know, Bitfarm. I don't know how to break this down. There's just so much data, but Bitfarms, Riot, and Iron are like most improved. Like their hash costs are going down a ton each quarter. Bitfarms has like a low cost just per kilowatt hour. So as they add more hash rate and more fleet, their hash costs go down. But I don't think people know how to look at their financials to like exclude one-off costs. So, for example, in Iron's report, they've had them at a super high hash cost and, or cost per Bitcoin. And I think that was a low blow. But Riot has their mega site, and, they just can add tons of hash rate there, and it's driving down their hash costs, which used to be really, really shitty. And now it's sort of like just a little bad. It's not awful. It's doesn't compete with, the other big guys, but it's getting better. And like maybe in 1 or 2 quarters, it'll be in line. Wolf just has a insanely low hash cost, but they're not really going to be pursuing mining that much. And they lost a big component of what makes their hash costs cheap. So they got rid of, what's it called? Nautilus.
They sold their JV in Nautilus.
So, but their costs are still like decent, and it's kind of muddy there because there's I don't know if they paid out an equity to secure some low cost or whatever, but just looking at cash costs, it's fine. So I think what stands out to me is Iron basically as the newcomer, building at huge scale and buying the latest generation equipments, and their actual like costs, their power costs and their overhead costs that they project, and which is pretty in line. All those things together, it's impossible to beat that. So as they scale out, their hash costs are just going to be insane. Like I forget what I posted, recently, but I think it's like in the 20s somewhere, and where CleanSpark's at 44. And the other guys are going to be in the 40s. They're going to crack through to the 30s in the next quarter or two. But like to be at 25 is just insane. That's like, I don't know, 30 or 40% cheaper than everyone else. So to me, I think the big winner is Iron, and I expected this for the whole year. I was saying is it might take the market until like Q4, Q1 to really appreciate the low costs, but you can't beat a new miner whose entire fleet is new equipment and operates at scale, and their costs are decent. And I'm saying you can't beat them in terms of your hash cost. I'm just talking about hash cost. So that was the big winner for me so far. And that's all I have to say. Cores has just been consistently like low, like competing for lowest hash cost. That's just because their SG&A component is like tiny compared to everyone else, and their direct costs are not bad. So they do pretty well. But again, they're not going to do any upgrades until the second half of next year. So I think this will give other miners a chance to like start eclipsing them. But I don't think Core Scientific is like particularly valued for their hash rate anyway. It's kind of just
not anymore. I don't think.
That's my take. Sorry, it's a bit long-winded, but
no, it's why we like to have you on, Penny. I think you point out some good things with Iris Energy. I mean, their joule per terahash nameplate for their fleet is 16 right now, which is the lowest of any miner. Of course, this has come at a huge cost for shareholders. They had, if my numbers are correct, I had to do some financial gymnastics because Iris reports according to Australian accounting standards. So like their fiscal year ends in the middle of the year. It's really obnoxious. But they issued like $792 million, or they earned $792 million from at the market offerings over the last year and other stock-based financing, which is pretty crazy. And they've also spent $807 million on PP&E, but that is for a lot of those next-gen miners that Penny's saying that's really reduced their hash costs. And it's been interesting to see them kind of rocket to the front of the pack in terms of having one of the lowest cost bases for any Bitcoin miner. Going back to Riot, I think like, or to your original question, Will, like Riot versus Iron versus Mara versus CleanSpark, I feel like none of them necessarily surprised me too much. maybe Riot a little bit. I mean, their uptime was just really bad last quarter. It's improving a little bit from where it was. So I would say that was one thing that I think is obviously a ding against them. I think on paper they'd be doing a lot better, and they would be a much more attractive play if they actually had better uptime, and it's not just related to their curtailment like we were saying on that stream. And then Mara also didn't really surprise me either. Just like some of the highest costs of the bunch, still trying to strip away that asset light strategy and go full asset heavy, and it shows in their operational costs and in their financials. And as for CleanSpark, I not really too much to add to what Penny said. I do think that you have to wonder just how much these acquisitions, while they're great on paper for growth, how much they might be hampering them from the operational side in terms of their overhead.
Oh, one thing you brought up, which is interesting, is it does come getting low efficiency and upgrading your entire fleet and buying new sites. It does come at a cost. It's like kind of the upfront cost you pay, and then from paying that upfront fee, then you get low ongoing cash costs, or low dollar per Bitcoin or whatever. So I wanted to like sort of bring into the fold how you might take account of that, and I think one reasonable way to do it is just if you have two companies with the exact same hash rates, but one of them has a lower hash cost, which company, would you value more, like on an enterprise value or market cap or whatever? And I don't think the market's fully to the point of like understanding hash cost, but I think once they get there, then they'll start to see, which hash rate would I rather own, the cheap one or the expensive one, if they're priced the same, or how much more do I want to pay for the cheaper hash cost company? So what I'm seeing now is like CleanSpark, for example. If you strip away the Bitcoin they hold and everything, and you look at how much you're paying for their hash rate, I think it's a little more expensive than Iron's hash rate. But, I don't think that should be, because Iron's hash rate is better, is lower cost. I'm not picking on one or the other. I mean, it's even more extreme if you look at Mara. If you strip out their Bitcoin and you just look at their hash, it's like you're paying a massive premium for hash rate that's way more expensive than everyone else. Like it's barely profitable. So I think the market has a long way to go in terms of those things. And it gets way more complicated when you say, well, the reason their hash rate's expensive is because they might have some HPC going on in the future, or their actual assets, their infrastructure they own is more valuable or whatever. So, but if you could strip everything away and look pure play versus pure play, it's purely is a numbers game, and I think there's some work to be done for the market to realize that.
Just to to kind of, I mean, maybe challenge is the wrong word, but to challenge that a little bit. I mean, I agree with you that hash cost should be one of the leading indicators for the health of a Bitcoin mining company, but we can't really ignore the fact that, like, if you're a Marathon, you've got, what is this, 34,000 Bitcoin on your balance sheet worth $7.9 billion. That certainly would have to factor into your valuation of the company, right?
That's why I would strip out the value of that Bitcoin. So how much are you paying just for the hash rate? You could say their market cap is 10 billion and 7 billion of that is Bitcoin. So 3 billion is what you're paying for everything else other than the Bitcoin. Now, if you want to like say, well, but it's not just regular Bitcoin they're holding, it's like MicroStrategy playbook Bitcoin, and so that's going to go up and all this, then yeah, it gets complicated and it's harder to do like an apples to apples comparison. But for something like CleanSpark and Iron, where they're both pure play miners and they both potentially have HPC upside, Iron speaks to that a lot. I think it's reasonable to say, all right, take out CleanSpark's HODL. How much are you paying for their enterprise of just their mining thing, and how much is that on a hash rate basis? And you can factor in that the hash rate may grow by some amount, and you do the same thing for Iron and you see which one's cheaper. And you can do that with like Riot. You can do that with a lot of the companies.
Yeah, that's a good point. You can basically see how much of it is a market premium, maybe based on the Bitcoin holdings, or maybe just based on legacy status, like we've talked a lot about with Marathon.
Yes.
I think that they have so much market share because of that, because they're one of the oldest. Obviously, they're one of the biggest too, but
yeah, and I think 2025 they're going to get. I don't know. It should be interesting, but I think if the hash rate wars continue, there's a few in the running to eclipse their hash rate, right? So then they're just left with big HODL, big market cap, high cost.
Yep.
I got a question about the banking side of stuff. So that was brought up in this conversation, and it's one thing I don't see a lot of the major miners talk about, besides Marathon trying to obviously buy Bitcoin just to hold it forever. CleanSpark, to my knowledge, actually, I'll give Hut 8 some credit for this as well. They've kind of talked about like having a forward look on holding this Bitcoin and using it for productive purposes, aka like using it for lending and creating a yield on it. And that's something that Hut 8 has certainly talked about in the past, and they've always had a decent sized hodl. Marathon, I haven't heard too much talk about. I think it's just more of the MicroStrategy playbook. And then CleanSpark, as much, I think it was over a year ago, they had a trading desk. I don't know if the trading desk is still live, but this is certainly something that's like really valuable. We can look at Galaxy Digital, for example, for that, where Galaxy's whole position over the last few years, even though they've been a pretty dominant miner that a lot of people don't talk about, they've just had a ton of Bitcoin and have actually been a lot of the underlying liquidity for some of these ETFs, and been facilitating that. So I think that the fact CleanSpark's bringing that up is interesting, and though it might not be super interesting to investor today, like someone in retail today, I think it's interesting from like a long-term mining perspective, where we always have people say like, "Oh, what are miners going to do when the cost to mine Bitcoin keeps going up and the value you get out of mining Bitcoin keeps going down?" I think like this, you'll see this banking sector emerge. And one thing I did, well, which is kind of dumb, but I looked at it while we're on the stream, was look at like the sizes of different banks by asset in the United States, and was like, okay, if they have 10,000 Bitcoin on their balance sheet, which is what they're projecting by December, and Bitcoin's at $100,000, whatever, that gives them $1 billion in assets. What does that mean for their size as like a bank comparison? And that puts them at like 850 largest bank in the US. And if you can see a world where Bitcoin keeps going up in value so much, and they start, lending and creating all these other services, you do get to a world where a Bitcoin miner with, a decent hodl on its balance sheet can transform itself into not only a Bitcoin miner and energy services company, but also some sort of financial institution. And that's like super far flung, like 5-10 years from now. But I thought it was worth bringing up because it was in the call.
Neo Bitcoin banks.
No one liked the comment. That's okay. You guys want
No,
to talk about
I'm searching things to make sure I have like a reasonable take on it. But I'm wondering where the demand for borrowing Bitcoin comes from. And you spoke to that in terms of like ETFs might need the liquidity, and they'd rather borrow Bitcoin than buy it at spot. Maybe they think they can get it cheaper later. I'm not sure how all this works. Just speculating. Yeah. But in order for there to be like cash flow from having Bitcoin, there needs to be demand for people to borrow it. And I'm sort of wondering if you borrow Bitcoin, what are you going to do with it?
You're going to short it.
What are you going to do? What are you going to buy something with it, or are you going to re-lend it? Like, where does it go? What do you do with Bitcoin?
Well, we're envisioning a hyper Bitcoinized world here, Penny, where everyone lives on the Bitcoin standard, and people need to use their Bitcoin.
Transaction fees super high, or not?
Whole other conversation. But I mean, like, Bitcoin is capital, and Coinbase does this. It was in the presentation, right? Like, a lot of miners take loans out from Coinbase and USD for their Bitcoin. I think there's a world where you do the opposite, where people take out USD loans for Bitcoin, and they work with someone like CleanSpark to be able to do that. So I think there's a world where that becomes more important for miners, and a conversation right now that's completely dominated by energy and machine prices. That's all I got, though. That's right.
I asked ChatGPT what the price to book ratio is of banks, and it says it's approximately 1. So I'm not sure there's a lot of extra value in holding the Bitcoin as a bank, but I don't know anything about this, so.
Yeah, maybe not to trade.
The Bitcoin bank, the Bitcoin bank topic is something I have a really hard time wrapping my head around it. The MicroStrategy play, all of this, people, who's buying the converts, that sort of thing has always been really confusing to me. It feels wrong. Maybe just deep down in my gut that it shouldn't work, but it seems to be working and has been working. It was the best trade of the year to buy MicroStrategy equity, and so Marathon took that and is running with it. So I guess having Bitcoin on your balance sheet and being a Bitcoin bank makes sense, but just somewhere inside of me, there's a problem with it, and I can't quite put it.
The reason why there's a problem with it is because the feds are buying those bonds, because it's all a big psyop, Nick.
Okay.
Well,
I mean, you said it on
speak to this a little,
This
Nick.
is a very serious news program, by the way.
So I wrote a post on. I spent like a week or two understanding the convertible notes and how convertible note arbitrage works, and when Saylor says they're selling the volatility, like how that actually works. So it's not that their price is going up because of the Bitcoin they hold. It's because they claim each time they sell a convertible note, they use the funds to buy Bitcoin, and that there's yield in that they're increasing their Bitcoin per share. And the catch here is it's only true if their share price rises up and those convertible notes end up converting. If that doesn't happen, they have to pay back that money. And they have a lot of options to do that. And it's, I'm not saying it's doom or whatever. I'm just trying to give some explanation of how it
But
works.
if people don't convert the notes, to your point, then they actually have to trim back their Bitcoin holdings or pull that cash out of the
Not necessarily. I mean, if they're trading at a multiple of their book value, of their net asset value, they can just hit the ATM and it still produces quote yield because the market's valuing more Bitcoin than they have. But I think it basically comes down to the companies are. It's not the fact that they have the HODL; it's the fact that they're pursuing the strategy of borrowing money to buy more Bitcoin. So you shouldn't value them on their HODL. You should value them on what their future HODL is going to be as they use this strategy. So I think that's where the premium actually comes from. And it's sort of a self-fulfilling prophecy. So the more people believe it's going to work, the more it works, because every time they buy Bitcoin, their share price goes up by 3 times the amount of Bitcoin they bought, and then those notes will convert, and then they can continue it. But it can also be a self-fulfilling doom loop where people don't think it's going to work, and it just goes the same way in reverse. So that's why I think there's a premium on there. I hope that helps explain it.
I would ask about like the people buying the bonds though, like
so they make free money. They're the big winners here.
But that would probably necessitate you already being bullish on Bitcoin, right?
No, they have zero exposure to. If they were purely talking like doing arbing of the notes, which is what Saylor means when he says they're buying our volatility, what they're doing is they buy the notes and they have like a free call option to get the equity at that conversion price, right? So
but
okay, what they do is they short the stock by the same amount of like the Black-Scholes model or whatever, and then if the share price goes up and they do convert, they're just going to have they'll have a short position equal to whatever the shares they're going to get from the notes. So they have zero exposure to anything except for volatility. They don't care if MicroStrategy goes up or down. They make money either way there as long as it goes up or down. They don't care about Bitcoin. They don't care about MicroStrategy. They just make money strictly from the movement in price of MicroStrategy stock.
Right. I guess I was just saying that it seems to me that you might also want to purchase these if you were just like generally bullish on Bitcoin because you expect MicroStrategy's price to be a beta play to it, right? And then you can cash into the stock later.
Although you're taking on some risk because you're buying the Bitcoin itself at like a 3x or whatever it is.
Right.
But if you think it's always going to be like that, then you just get leveraged exposure to Bitcoin.
And then we've seen that there can be one MicroStrategy strategy, but can there be 10 MicroStrategy strategies? That's a big question.
Yeah, I'm wondering how much demand there is for buying the notes.
Yeah,
kind of all hinges on that, and that hinges on volatility, and it's a whole like positive feedback loop. I mean, so far it's worked for Mara in their share price at least.
Yeah, I feel like to your point though, Charlie, maybe there's a point where the market reaches saturation, but we have seen at least with public Bitcoin miners that the market seems to have almost endless appetite for high beta plays to Bitcoin. So at a certain point though, I feel like the market will get exhausted with it. All right, fellas, final thoughts on CleanSpark's fiscal year 2024. Nick, we'll start with you, then we'll go to Penny, and then we'll go to the peanut gallery.
All right, I'll give it a performance review. You've got 1 through 4. 1 is you're fired. 2 is like not performing well, but okay. 3 is meets expectations. 4 is like exceeds expectations and going to get promoted. I would say meets expectations. Meets expectations. It's kind of it's a bit of a milquetoast take, but it was a good quarter. Wasn't the best, wasn't the worst. It was right down the middle.
Penny?
I think I've said enough on it, but if I'm using the same scale, I'd go with 2.5 or 2. Like I don't like seeing the cost go up. You did have a worse hash cost than the previous quarter, but overall compared to everyone else, it's like pretty good. It's good. It's okay.
I think that's the thing is like we're grading them on like there's a curve here, and I don't know if there's anything crazy compared to what we've seen from the rest of the mining stock ecosystem. But Charlie, Will, what do y'all think?
Yeah, I mean, I like to see a super mega pure play miner. I wish we could get all three of a pure play miner who can produce a Bitcoin for the cheapest and has the most access to capital. Apparently, it's like the miner's trilemma. You cannot have all three.
That's really good, actually.
Peanut Gallery has not much more to add to the conversation. So thanks for letting me hop in with you guys.
Same on my end. Hey, Penny, Nick, thanks for joining us. Where can our listeners find y'all?
You can find me at #Bender or the company at Luxor on Twitter.
I don't actually exist. I'm like an extension of ChatGPT.
In the ether.
I knew it.
Oh, come on, Penny. He's
an ether plugin.
I have a Twitter account. It's Penny_ether.
Penny_ether, and he always has really good takes on a lot of these miners that we cover. So definitely give both of them a follow, gents. We appreciate y'all joining. To all of our listeners, you know where to find us at the Mining Pod on Twitter, at Blockspace Pod. Please subscribe to our newsletter at newsletter.blockspace.com and check out our YouTube channels as well for all of our podcasts, including Bitcoin Season 2, that beautiful fella in the middle of the screen here with his purple lighting behind him. And with that, we will call it a wrap. Thanks for joining, y'all. Hope everyone had a good Thanksgiving holiday, and we will see y'all on Wednesday for a more comprehensive recap of the Q3 numbers from these public mining stocks. Deuces, everybody.